Yeah, I'm losing my edge.
Today I want to talk about the Small Exchange Subscriber newsletter. Everybody's talking about this. It's the newsletter heard round the financial world. That's not true, and I don't think that saying actually works for this scenario. But anyways, I'm going to explain what the Small Exchange subscribers are currently getting and what the Small Exchange is offering to all of you out there. We came up with this subscription here as a modern take on the old futures exchange memberships. You get this seat and you get exclusive access to trading on the floor of the old Chicago Mercantile Exchange or the Chicago Board of Trade, these different places. Here in 2020, that concept not so relevant, but we did update it to create this Small Exchange subscription, which allows you for one payment of $100 to get the lowest fees in trading small exchange products and a lifetime subscription to those low fees. And now weekly content that is going to serve as what I think is a great companion to your trading in the small exchange products. It's really near and dear to my heart. Although I didn't come up with this subscriber, the subscription offer, I have taken it upon myself to take it all the way to the depths of where we possibly can in building a nice, cool trading experience for you in the smalls. We have 2 stock products, a metals product and a foreign exchange product. By the end of the year, we should have at least 1 or 2 other products that range new asset classes here, hopefully diving into energies and interest rates. And as we build that out throughout the rest of 2020 and beyond, we want to create all of these different products, all these different asset classes that get you efficient exposure, margins of only a couple $100 to trade these futures products, and universal simple contract specifications. So if you bounce between trading our tech stocks to trading the US dollar to trading crude oil and interest rates and beyond, everything is ticking in the same value. It looks the same, and they're relatively similar sizes. So you don't have to deal with this thing being $200,000, this thing being $150,000. No, everything is just a few $1,000s in product value that cost you just a couple $100 to trade. And with the product offering expanding, but looking the same in terms of those specifications, we wanted to create a subscription that allows you to trade those products for as cheap as possible to replace, these other futures that have, exchange transaction fees of $1, $2, even up to $5 and $10 in some places every time you trade. No, with the subscription, every time you trade the smalls, it's just 7 cents in those transaction fees, and then a couple of other small fees, no market data fees to start, and those market data fees will be really low, exclusively for subscribers as well. But now we're offering the content side of it, this weekly newsletter that does a diagnostics check of all of the different small exchange products and spits out some advanced stats, some metrics to update you on every week, and create this experience that helps you make informed decisions when you're trading the smalls and keeps you in our world, our universe. And this is something that's going to go out every Monday morning, and it's going to be updated using Friday's opening trading values or as close as we can get to that Friday close. And we do mark when that data is updated as of at the bottom of the subscription, but that's not so much fun. What is fun is the fact that you're getting on the first page here where the markets are, their highs and lows, kind of easing you into the experience of the smalls. It's Monday morning. You're still, rubbing the sleep out of your eyes and getting your first cup of coffee and getting ready to trade the markets. Where is everything? Where's it been? And then also here's a nice little piece of written commentary from myself or Peter Momat, or even we're toying with some outside contributors as well, ranging from tasty trade personalities and beyond, other brokerages or what have you, some personalities giving their take on that week in the market. And I'm always going to back up my stuff with a bunch of numbers. You see here, we've got some statistics, some trading strategies, some nice visual references for that content. And then we're going to move into the pieces that move less from week to week, but help you gauge these moving markets very quickly and very easily. The advanced metrics that we feature in this small exchange subscriber newsletter are going to fit in trading and investing. And then on the back end of the newsletter, there's a nice clean hedging page that gives you all your ratios and formulas for hedging and pairs trading. But before that, you've got these trading metrics, these advanced stats for fast ideas. Then you have your investing metrics, which help give you the whole story on how you're invested if you do choose the smalls for longer term trades. And these are going to update constantly, and they're going to lend to the short term speculator and the longer term investor in a way that we think is super useful. So yeah, at a high level, what you're going to get on something like the SM75 here is the example is a day in the life for the trade the smalls, the dollar plus index, and a volatility range. That day in the life is going to give you the one standard deviation normal range, and then also give you a little bit of a further backdrop for the biggest moves. So that one standard deviation normal range is really, for me, a summary of what this market can do on a daily basis. More technically, a standard deviation is going to entail me taking the last, and most of our metrics here are about 3 months worth of data, which is, I think, a great sweet spot of constantly moving and adapting to current times and giving you a historical context that isn't a mere reflection of what happened yesterday. If you're just using yesterday, it's maybe a little bit too recent of a bias. But if you're using, metrics over the last year or 2 years, it might not be. It might be too much, not recent enough, because you go through these periods of high volatility, low volatility, and so we do 3 months of number crunching for most of these metrics with that day in the life standard deviation. The last 3 months worth of daily changes, I wrap a standard deviation around those changes so that you have this plus or minus move that SM75, for example, has closed within 68% of the time. So 68% of the last 3 months of closes, SM75 has done so within 70 cents. Now, the biggest move to the upside in SM75 is $1.20. Biggest move to the downside, $1.90. And so that gives you, to me, the most intriguing part of that graphic is exactly, and I can bring up a larger version of it, right here, right between that normal range and those highs and lows, because that's where, to me, the action is. When SM75 is up 10 or 20 cents, not a lot for me to do there. Up or down 10 or 20 cents doesn't really matter. I don't really care too much about direction. But when it breaks out of this normal range and it gets into this, oh wow, SM75, it's up $1 today, or it's down $1.20. That's intriguing to me, because now I'm seeing something that is abnormal. And we find historically some of the greatest edge in trading futures when they're in a little bit of that abnormal setting. And so I usually look for moves that are outside the normal 1SD move, that are maybe getting to these historical extremes. And that's where I find the greatest entry points. And then also, this metric is great for management. A lot of people ask, if I'm coming from the world of just buy and hold investing, or I'm coming from the world of stock option strategies, in futures and directional short-term trading here, how do I manage stuff? Where do I set mechanics? Well, it's very similar to me for anyone who's coming from that options world, who's used to saying, okay, I bought or sold an option strategy and I want to manage it for 30 or 40 or 50% of what I could potentially win on that option strategy. With futures, it's really the same thing, but taking that credit or debit from options and applying it, those same percentages that you would, to this average one standard deviation normal move. And so with that, in this SM75 example, what I would look for is entering a position, anything that's around the plus or minus 70 cents or outside of it. Like I said, that's intriguing. That's where I might see some edge. And then management is just merely, okay, how can I create realistic expectations? Well, borrowing that percentage of potential profits and losses from options, I could do a percentage of this daily move. So, for instance, you know, the simplest strategy that I could create using this graphic is to say, all right, I'm looking for something outside of 70 cents. I'm going to maybe sell up a dollar or buy down a dollar. Now, where do I realistically set some levels of management around that? Well, let's just look at 50% of that, or 50% of this daily move. So I'm looking to, if I'm buying it down a dollar, I'm looking to sell it back when it's only down 50 cents, or get out for a loss when it's down $1.50, and use that percentage marker relative to my entry points, or just these actual daily 1 standard deviation moves. That's how I use this metric here from A to Z in scalping. And then you also have the dollar plus index, which is just a nice clean measure of how often you are seeing outliers. That's how I read this. And so right now it's 22% in SM75, which is actually pretty high. But if you'll notice that SPRE, the metals have been moving a lot. That metric here for the dollar plus index is actually closer to 50%. So any these outside days, we're seeing a lot in metals, a little bit less, but still a good amount in our stock products. And then in SFX, you'll notice that currencies have been kind of muted recently. That dollar plus index only at about 5%. And so that's a nice gauge for markets that are maybe showing some either outlier risk or potential in trading big outlier moves that are outside of a dollar on either side of these small exchange products. And then finally, in the trade the small section, you have this volatility range. I'm calculating the realized volatility as it currently is in that market, and then the highs and lows. And so that's in options, you've got the implied volatility that lets you know how expensive or cheap options are relative to historical prices. Realized volatility gauge is letting you know how much opportunity there is, how much movement there is in the market, real movement in the market for scalping these futures relative to those highs and lows. And so you'll know that, if this realized volatility is closer to the low side, that the market could potentially, scream off the page at any point. But right now it's showing some pretty muted movement. If it's on the higher end, you're seeing some of the most volatile price action in that market. And then also you can lend this 22% number. That is a summary of realized volatility and implied volatility are both measures that equate to the annual percentage move that's expected out of this market. So in the next 365 days, this 22% is telling you that given recent movement, SM75 is implying that its range for the next year is about 22% plus or minus, which makes sense. If you saw the recent movement in SM75 the year so far, 22% over the next year, it makes sense there. But I would mostly use this volatility range just as a quick way to see, this market is moving a lot relative to historical price action, or it's actually not moving that much relative, and then set some expectations around that. You can also lend it to when options start trading on these markets. The implied volatility, realized volatility spread will be really intriguing. If you're seeing an implied volatility in SM75 futures options of 40%, but this realized volatility is at 22%, might be a good sale opportunity in options. So that's also a nice little piece of that I actually hadn't even thought of. But let's dip into the investing side of this newsletter as well. You've got nice, clean, recent returns graphic here, letting you know the path that these markets have taken to the current 3-month return. So you got SM75 up about 10%. It's been pretty much all north of 0% for the last 3 months, and quickly letting you know that this market is actually right back to those recent highs, giving you some context if you wanted to buy or sell that market for more than a day or so of opportunity. And then also, what can I expect in terms of volatility around this market? So I see that it's up 10%. if I wanted to buy it here or sell it here for the next 3 months, what am I expecting in percentage change of my profits or losses? Right now, it's about 5.6%. And that's just a nice risk gauge what I can, like I said, expect my P&L for one of these SM75 contracts to fluctuate over the next couple of months here. And then also what I think is maybe the most intriguing piece of this investing portion of the newsletter is the largest component piece, which is going to give you the weight, return, and net effect of the largest component in the index. And that's going to change as those components fluctuate. Right now it's Tesla for SM75, could be an energy stock or a financial stock or anything else in the future. And it's going to let you know that recent 3-month return of that component, and then how it's affected the index. And so if we go deeper a little bit on this SM75 example, this type of analysis is really some cool, clean, under the hood metrics that help inform long-term opinions. If you were to look at this graphic for the S&P 500 or the NASDAQ, you would see this weight piece be a lot fatter for the largest component. For the NASDAQ, Apple is the top name. That Apple stock is, I think, about 15% in terms of weighting of the NASDAQ 100. And whatever Apple has returned is going to have a huge effect on the index at large. Now, that might be something that you're interested in. Maybe you want to invest in top-heavy indices, but what you'll see with the small exchange stock indices is smaller weightings. Even Tesla, the largest component, only 1.6% across those 75 stocks, very near equal weightings, and a huge outsized return here of 50%. That is nice. Of course, if you bought SM75 3 months ago, you would wish that it was all Tesla, given this 50% rise. But this muted effect, this more diversified look at exposure in terms of weightings here is going to reduce the outlier risk that could owe to single stocks. I honestly, when I'm investing in a stock index future or a stock index ETF, I don't want something that's 15, 20, 30% one stock. I would just buy Tesla shares at that point or Apple shares. What I want is something that is getting me diversified exposure. So, next month, Tesla could be down 50%. I don't want my whole investment to be down, 10, 25% because of this one stock move in a 75 stock index. And that's going to let you under the hood of SM75. And then also what'll be interesting is checking it out for our commodity futures as well, the SPRE contract. That's gold, silver, and platinum. Gold is right now the largest component. It's about, I think, I want to say like 50, 60% of that commodity index there. And now you might say, oh, well, now you're getting away from that diversity thing. Well, there's only 3 major precious metals, and gold is the most popular one. So very different than a stock index. But anyways, that's going to let you know how gold is affecting those futures and how you might want to look at that relative to shares of GLD or GC futures as well. So that's going to be a cool thing to look at when you are assessing how you want to invest, where you want to employ these long-term opinions based off of the exposure and how that affects these indices here at the smalls. And then finally, maybe not the coolest thing traditionally, but I think a really cool part of this newsletter is our constantly updating ratios and correlations, and then some featured content here at the top right, featuring what we think is a very intriguing pair. As you can see, to kick it off, we're looking at the fact that gold and platinum have lost a ton of ground relative to silver. You can see here, this is SPRE versus silver. SPRE peaked in about mid-March over silver, and it's been nonstop silver beating up that SPRE futures, which holds gold and platinum as well. And so you get a little bit of commentary on pairs markets, and then also a little bit of a formulaic approach to hedging. Hedging is one of these things that, as an idea, I think is pretty easy for people to grasp. Whether you're gambling, investing, whatever it is, it's this idea of I have this opinion or I have this position, and it's gone in my favor or it's gone against me, and I don't want to just completely abandon it, but I do want to take some of the exposure off the table. That's an idea that I think most of us can jump on with. But one of the questions we get all the time is, okay, how much am I supposed to hedge? How do I complete that hedge? What products do I go to get the best hedge for that? Right here, you've got the formula that says, okay, what is your investment value? What's the position here? How much do you have of long stocks or short currencies or whatever? How much do you want to hedge of it? And just a simple percentage, if you're like, oh, I just want to hedge a little bit of it. I'm not super afraid of this position going against me, 10, 20, 30%. Or, you're afraid of a big stock market reversal and you've got this portfolio that you've accumulated over decades of long stocks and you want to hedge 40 or 50% of it, plug that percentage in against your position value. And then you take any of these small contract prices, whether if you're hedging Russell, SM75, going to be the best hedge against that. If you're hedging NASDAQ, STIX going to be the best hedge against that. Gold and silver with SPRE, and then currencies over here. Plug whatever small you're using as that hedging tool, plug the price in here, times 100. That's going to spit out the number of smalls contracts you're going to want to use to hedge. And then you'll see that, and you'll maybe hopefully conceptually grasp that 100% in the hedge percentage simply gets you to that pairs trade. Pairs trading is just saying, I've got an opinion on market X. I want to not trade that market up or down, but trade it against my opinion on market Y. And so I'm going to hedge 100% of market X's opinion against market Y, and that gets you to a pairs trade. And that's all these ratios here are pairs trades of SM75 against stock ETFs, STIX against stock ETFs, SPRE against metals ETFs, and then the same with SFX against euro, pound, and yen. And then also using these small micro futures or mini futures or what have you as a mixed bag down here for the futures versions of those pairs trades. And those ratios will update as markets shift and this market gets larger than that market. We'll adjust all these ratios for you on a weekly basis as they warrant changing. And that's how you can apply these correlations that you hear about constantly to risk management and pairs trading. And that's going to bring you to the end of the current version of the Small Exchange subscriber newsletter. It's been a fun couple of weeks and months getting this together here. We're super excited about it for our current subscriber base, driving more people to subscriptions, a great companion piece to trading the smalls. We'll be updating it every week, like I said, and we'll be updating it for future products down the line. It's going to be a beautiful evolution of this content.